We are starting with the panel of GST. I hope this will be a very interesting one for all of you. Thank you so much. Over to Sujit.
Thank you. So we've got the stage at 3:20 and we will close at 4:20. That's not a good number. Okay, so I guess all of us have been waiting with bated breath in terms of what happens to GST legislation. The Parliament has been hijacked because of the demonetization issue, so we thought in the last few days the legislation would have got adopted. Much as we may want to, it seems that it will still take some time before the legislation becomes a reality. So what we have gathered today is a panel of very distinguished people. We'll divide the conversation into 4 parts. First, we will have an overview of the proposed legislative regime in India under GST. Second, we're going to request one of our experts, Denis, who's from PwC, to share his experience of the Australian GST and how it compares with India, and what are the areas where he thinks there are issues to be ironed out. Thereafter, we'll have Onkar, who's going to speak about the proposed GST or VAT in the GCC countries, which is also planning to introduce that legislation sometime in 2018. What kind of learnings we have from there. And then we'll have ASHOK, he is a barrister. ASHOK, if you could then give your thoughts on, as a professional practicing in Australia, what your thoughts are. And then maybe if there is any questions to be taken, we'll do that. But it seems like we have a very thin room, so I guess it will be more of a motley crowd of people trying to understand one another, be it as it may be. So Mannat, over to you. If you could just, okay. Come up. Yeah. So, Mannat, you have a little over 15 minutes. Maybe just keep it at 15 minutes so that we can slice and dice the rest of the time for the others, right? Thanks.
Hello. Good afternoon, everybody. So I am going to start this presentation with introducing the Indian GST law, and so the topics that I'm going to take you through are the Basic Constitution Amendment Act, which was passed in September, and the various amendments which were made in the Constitution so that the GST law could be brought into place. Basic key features of the GST law as would be important and can be understood by all, and then certain nuances of GST law which may be applicable to different industries. So starting off with, I will take you directly to the Constitution Amendment Act. One of the key features or the key changes which were brought in were, prior to the Constitution Amendment Act coming into place, there were certain, so Article 246 existed, which provided that the power to levy, to make laws in relation to List 1 would remain with the centre, whereas the power to make laws in relation to matters listed in Entry 2, List 2 would be with the state. Now for the GST to be applicable or leviable, there had to be a simultaneous power which had to be given both to the state as well as the centre. As a result of which, Article 246A was brought into place, which gave a concurrent power both to the centre as well as the state to make laws in relation to GST. Now the tax or the law in relation to GST or the law in relation to sale in the course of interstate trade or commerce was retained with the centre. Now there was an interesting thing to this. So what has happened is there's another article called Article 269A which has been inserted. What they've done with that is they have retained with the centre the power to make laws in relation to GST for sales in the course of interstate trade or commerce. Interstate trade or commerce means between one state or the other to the other. What they've done is they have deemed imports to be sales in the course of interstate trade or commerce, so that the centre has the power to levy tax in relation to such imports. But they have not levied or they have not deemed exports to be sales in the course of interstate trade or commerce. When the draft GST law and the draft IGST law came into place, what they have done is they have deemed both sales, imports as well as exports to be sales in the course of interstate trade or commerce. So there's a question which arises that can the GST or can IGST be levied on exports, treating them to be sales in the course of interstate trade or commerce, in a situation where the constitution does not allow this and the power is only restricted to imports being in the course of interstate trade or commerce. Then apart from that, we had certain other amendments which were made, which included the constitution of the Gst Council. I'm sure a lot of you have heard about news in relation to Gst Council. A number of meetings have been held where there have been rules which have been, draft rules have been released, rates have been released in relation to GST. There has been a 0, 12%, 28%, 5, 12 and 28% rate. Apart from that, there have also, so the next meeting is scheduled for 2nd to 3rd of December. And so there have also been a lot of amendments made in relation to the list, because as we understood the taxes previously, we had a tax on manufacture of goods, which was excise. We had a tax on sale of goods, which was VAT. We had a tax on services. So if you would see in the last 2 bullet points, there have been certain amendments which have been made in the list. And so for excise duty, it has been restricted to 5 petroleum products: crude oil, HSD, MS, ATF and tobacco. Whereas similarly in relation to VAT, it has been restricted to the petroleum products as well as alcohol, as we know is subject to state excise duty. There has been an important definition which has been inserted, which is the definition of GST, which is a tax on supply of goods and services. Keep on doing supply of goods and services, which is a shift from what taxes we understand right now, which is a tax on manufacture, a tax on sale, a tax on services. And exclusion has been made for supply of alcoholic liquor for human consumption. So this means that if you would see previously, there are certain goods which have been kept outside the GST ambit right now, which are crude petroleum, ATF. But there has been a date, so the Gst Council will give a recommendation for the date from which those goods will come into the ambit of GST. Whereas for alcoholic liquor for human consumption, the definition of GST by itself has excluded this. So whether it can come back into the GST realm at a later point of time is a question. Services has been defined in the widest possible manner to mean anything other than goods. Goods definition is the same way as it was always in the Constitution: all materials, commodities and articles. Now what the GST law has done is that apart from the definitions which were inserted in the Constitution, there is a separate definition for services which has come out in the draft GST law, where services have been defined as means anything other than goods. By an explanation, they have included intangible property to be included as services. Now this may be to settle the ongoing litigation of whether software would be a good or service and all such disputes. So they have deemed services to software to be, or intangible properties to be, services. However, as we see the Constitution definition right now, since it means anything other than goods, and goods includes materials, commodities and articles, and the various decisions of the Supreme Court, including Tata Consultancy Services, which has always defined software to meaning goods, is it that the draft GST law has gone outside the purview of the Constitution by defining intangible property, which is considered as goods in the Constitution, as a part of services? Other than that, there is also a question on actionable claims, because under the draft GST law, the definition of goods has been defined in a manner to separately exclude actionable claims. Is that even possible, given that the definition of goods under the Constitution does not make any such exception for actionable claims? Moving on, so Gst Council, there are various recommendations which the Gst Council can make. This is also part of the amendment in the Constitution. Rates are something which have been recently notified and have been in the public domain. As I said, there is a separate date which the Gst Council can recommend for levy of GST on the petroleum products, and special provisions for certain states. Goods and services which may be exempt under GST. This is a question which almost every industry is facing or battling with right now, that will our present exemptions continue under the GST? This is something that we just have to wait and watch, because right now no such exemptions have come out. Apart from the rates, there's something else which has come out, which you must be knowing about, is the cess which is being levied on certain luxury goods as well as demerit goods, which is something that is, because most of the cesses and taxes were supposed to be subsumed under the by the Gst Council. So this is something which is a new thing which has come. Now moving on to the GST law as such and the key features. So the basic point is the taxable event under the GST, which is the supply of goods and services in both. So it is not manufacture, it is not provision of service, it is not sale, it is not the entry of goods, it is a basic supply of goods and service. The first question that comes into everybody's mind is, what is supply? And the way the definition of supply is worded, it's again worded in the widest possible manner because it starts with the word includes. It includes sale, transfer, barter, exchange, license, rental, lease or disposal for consideration. So this means that there is no specific definition of sale. These terms, sale, transfer, barter, exchange, license, have not been defined under the GST law, so you look at it in common parlance. Other than that, supply also includes, or supply has also been said to include importation of services, whether or not for a consideration. Supply is specified in Schedule 1, supply without consideration. I will elaborate on this later. Transaction between a principal and an agent, and supply of branded services by an aggregator under the brand name or trade name owned shall be deemed to be a supply by an aggregator. So this is the definition of supply. There is everything and anything that can be included since it's worded in this manner. Moving back to the taxable event. So the charging event being is supply of goods and services. Now there is a GST law and there is an IGST law. The GST law, which is basically the levy of CGST and SGST, Central Goods and Services and State Goods and Services, would be leviable on the interstate supply of goods and intrastate supply of goods and services, whereas the IGST law, that is the Integrated Goods and Services Tax, would be leviable on the interstate supply of goods and services. Now, it's interesting that interstate and intrastate have only been defined under the IGST Act. They have neither been borrowed nor any reference has been made in the GST Act. So one has to again go back to the IGST Act, which has no reference to this. And moving on, so the way they have defined it under the IGST Act is an interstate supply of goods and services is a supply where the location of supplier and the place of supply are in two different states. What they've also done is they've said imports and exports, as I had explained earlier, would be deemed to be supplies in the course of interstate trade or commerce. So, and thereafter they have certain rules which have been formed for place of supply in order to determine where is your place of supply of goods, in order to see whether it's in the same state or in the separate state, and accordingly CGST or SGST or IGST will be leviable. There's a glitch in the charging section which we noticed when we first read the law. While there is a taxable event, there is the person who is being taxed, and there is the rate, or rate can come out specifically from the schedule, which is coming out of the charging section. There is one very important aspect, and that is the measure of tax, which has not been prescribed in the charging section at all. While there is a separate section for transaction value, there is no reference to this in the charging section. And there is a very renowned judgment of the Supreme Court, Govind Sir and Ganga Sir, which specifically says that if the charging section is bereft of any of the four measures which I just mentioned, that charging section fails. So in effect, the draft GST law which is in place now does not have any reference to the measure of tax or the value on which tax would be leviable, and hence we can in one way say that the charging section can fail. So this is one point. We hope that in the model GST, in the revised GST law, which has in fact come out today itself in the afternoon, we hope that these issues would have been addressed and moved on.
We have 2 minutes.
Okay. So moving on, there are a lot of small problems in the draft GST law which we've highlighted. There are certain definitions which have been made, but there's no reference. Deemed export is something which everybody was looking at. What is it going to be? How is it going to play into the GST law? This is not something which has been defined. Intrastate and interstate has not been defined. SEZ is something which is being amended, as we know, in relation to GST, but right now there are no provisions under the draft GST law in relation to SEZ. Moving on, I had explained this. So, okay, one very interesting thing is barter and exchange as a concept have come under the definition of supply now. So this brings 2 or 3 aspects into play. One is that, so as barter or exchange, as anybody understands this, if I give you a glass, you give me a bottle. Now there'll be a GST impact on both, so both will be supplier and both will be receiver. What would be the valuation? The basic principle still remains. Can a supply for one person be the consideration for the other person? So these are 2 or 3 aspects which we are still battling with. Maybe a clarification comes out. Would it be a two-way supply or would it be a one-way supply? How would it word out? We're still to see when the final GST law comes in. Import of service is one where they have said with or without consideration. it would be leviable to GST. That's a little different from import of goods where, and the second aspect is with or without consideration, whether or not in the course of furtherance of business. This is a little different from import of goods where they're still retained it to be in the course of furtherance of business. So import of service, even if it is not in the furtherance of business, even if it's without consideration, it would be leviable to GST now. So this is the third part of supply, deals with supply without consideration. This is something that everybody actually opened everybody's eyes, because now all supplies of goods and services which are in the course of furtherance of your business, meaning all your branch transfers, all your transfer of services between one entity to the other entity where there was only a book entry made right now, would be leviable to GST. So practically, as we have been examining the transactions of different companies, we came across stock transfers which right now are only done against a compliance form and were not leviable to CST. Now what has happened is, apart from them being leviable to GST, there is another aspect which says that, so there's a schedule which provides that matters which are to be treated as supply of goods or services. So certain transactions have been deemed to be supply of services. One very important amongst them is any transfer of goods or right in goods without the transfer of title is a supply of service, which means if there is any branch transfer or inter-unit transfer, there is no transfer of title over there. That means that supply will not be considered as a supply of good, but will be treated as a supply of service. Meaning, all your valuation which is in relation to your supply of service will trigger for that, which may not be logically possible in terms of a supply of good. All your place of supply, so you have different rules which have been laid down for your place of supply of goods, for determining place of supply of goods, and separately for place of supply of services. In this case, as your stock transfer, your branch transfer of goods will be treated as a supply of service, you will have to look at place of supply of service rules, which again may not be logically possible. But the way the Act has been worded right now, and we see it, if there is no transfer of title in the goods, it does not become a supply of goods, but is treated as a supply of service. So that is something that probably a clarification will come out, or probably they'll have separate rules notified. We'll see.
Mannat, 30 seconds more.
Yeah, also another possibility in this is that there may be a rate arbitrage. Right now we're looking at rates which have been notified for goods, which is 5, 12, 18, 24. There is no specific rate which has come out for services. So in case the rate for services is say 18%, we're looking at a stock transfer of goods which will be leviable to an 18%, whereas the same goods when they're being sold in the open market or to a client will be sold at 5 or 12%. So that rate arbitrage is something that will have to be dealt with. Input tax credit. So the whole GST was founded on this basis of free flow of credit. There are going to be no input restrictions. Right now, all the credit restrictions under the VAT and SENVAT credit restrictions will come to an end. But this unfortunately has not happened. There are a number of credit restrictions which still exist. Most of them have been taken as a mixture of both from the state VAT laws as well as the SENVAT credit restrictions. And so these are something that again has to be dealt with. And there are one very important restriction that I would want to highlight is goods and services which are acquired by the principal in execution of a works contract when such contract results in construction of an immovable property. So right now this kind of restriction was only restricted to services, was not in relation to goods, but with this restriction coming in and the way this restriction has been worded, it would be applicable in case of all inputs or goods and services which are used for construction of an immovable property. Apart from that, another restriction which is very interesting is all goods and services which are used for private or personal purposes, input tax credit would not be available. This is interesting because if you would recollect, I showed you a schedule which says all goods taxable, supplies which are taxable without consideration. In that you include services, whether it's for personal use or for official purposes, it's leviable to GST. If you use your assets for a private use, those are also leviable to GST. So you're levying a GST on those taxable supplies when they are for a personal use, but you do not allow the corresponding credit in case if they're used for personal use. So that becomes a complete cost to the person who is using those goods for personal. I'm sorry? determination at it?
Can we take the questions later, because we have to finish the panel discussion and then we'll do that.
So,
Mannat, I think we'll have to close
I
now.
think I'll close
Thank
now.
you,
So
thank you, Mannat. Thank you. I think I must also add that I was just going through the latest version of the legislation, draft legislation that came out about a couple of hours back. It seems the government has taken pains to, deal with some of the vacuum and some of the lacunas that were there. Be that as it may be, it'll take some time for us to appreciate what the changes are. In the meantime, Denis will share his thoughts on how he perceives the Australian GST's, architecture compared to the Indian GST and what his suggestions are for the country. Denis.
Yeah. Thank you very much, Sujit. I'm not sure if you'll be pleased to hear this or not, but I don't have a PowerPoint presentation, so you can either look at me or look at my far more attractive panel during this discussion. What I thought I'd do, just by way of background, in a sense, back in 1997, myself and 5 other people were asked to work with the Australian Treasury to design and draft the Australian GST law. So what I thought I'd do this afternoon is almost take you back to these sort of really fundamental principles, things that we did at the time to design the law, because these were the touchstones and largely still are for how our law is put together. And you might want to then have a look at those and consider some of those principles when we start to consider some of the more broader things in the Indian law. That'll take about 10 minutes, and once we've done that, I'll pick up on a few of the key Indian concepts and talk about both, terms of good design, etc., and just some thoughts around those. But just also by way of background, the Australian GST came about as part of a much broader review of the Australian taxation system, right? And essentially what happened was the GST, broad-based consumption tax, set at a rate of 10%, replaced what was previously a wholesale sales tax system that applied to some goods at varying rates, no tax on services, and obviously by the time 2000 had come around, as much more people's expenditure was going towards services and goods. So that part of it needed to change. It also gave the and so what they did was that income tax rates went down, corporate tax rates went down as well, a bunch of inefficient state taxes were removed. The money into the transaction safely knowing what your tax position is. Taxation system should be effective and fair, so it should collect the right amount of tax at the right time. The system should also be flexible so that it can cater for changes in the economy, changes in new types of products, for example, a shift from traditional goods to digital goods, etc. And the final one is that it should be efficient, right? Collection costs for government should be kept to a necessary minimum, and compliance costs for business should be absolutely kept to a minimum. So with those sort of 5 principles in mind, then you think about it and you think they all make sense, right? So when it comes to a GST, first thing you do is, what's a GST designed to do? Fundamentally, it's designed to tax final private consumption expenditure in your tax jurisdiction, right? It does it by taxing each step in the supply chain, generally, but you're getting credits for everything that you purchase until such time as somebody who's not registered buys something, they don't get a credit, and that's where the tax sticks. Now, in order to do that, there's any one of a multitude of different ways. At the time, we had what we call the Tax Law Improvement Project in Australia, which was all about designing a law that had a relatively simple and logical structure to it. But then it started to fall back on principles that the law, to allow businesses to comply, the closer you stick to accounting principles and to their financial system, the easier it is for them to do it. As soon as they have to start to run off reports and to do things that aren't a natural part of the way you operate, all of a sudden compliance becomes really difficult, compliance costs go up, right? And what will often result in that is non-compliance or problems with compliance. A couple of other things. One was also trying to determine the status of the recipient. We avoided, so in other words, if you sell widgets and those widgets are taxed at 10%, it doesn't matter who you sell them to, they're going to be charged 10%, right? There'll be nothing like, oh, it's going to government, so we won't charge government, but it's going to a private individual, we'll tax them. So with those things in mind, the third thing that also happened during our GST implementation was the role of the tax authority, and this is going to be really critical in terms of how India actually implements the tax. And I've got to say, the Australian Taxation Office did a fantastic job at that time, right? Effectively, they went straight into education mode. Their philosophy was that, taxpayers want to do the right thing and they want to comply, and we will help them comply by telling them what they have to do, right? It's not traditionally what tax officers do, right? And something tells me that it's not necessarily what the Indian tax office is going to do, but it made a huge difference. For 2 years after the tax came in, they were still in education mode, right? Didn't mean that they didn't collect any tax. There were certainly no penalties. They were out there, their auditors are actually out there telling people what you need to do, and and if they found an error, they'd get them to fix it up and then just move on. Also, their audit process, to the extent that it was around, there wasn't a lot of it, was all based around risk assessment and identifying people who are not trying to do the right thing, right? So that became really critical, and having a smooth transition was just the way the tax authority is going to behave, and it will be the same here, right? So issues around, and I've been going through them with the financial services sector, issues around just getting quick decisions on what you have to do so that they've got certainty to be able to set up systems and things like that is critical. And I don't see a lot of feedback coming at the moment about really key decisions. So with that sort of background in mind, I thought I'd just sort of raise a few of the issues in India as I see them at least. And the first critical one, which Mannat went through, you look at how these systems start off. This sort of dual system of having both a state and central GST is probably the worst possible way you could have started to design your tax law, because everything else follows from that, and everything that's going to follow from that is going to be really difficult and really messy. So if you look at the Australian system where the states get the money, it's collected by a central authority. There's one tax. It doesn't matter. If you sell goods, from Sydney, which is in New South Wales, the state of New South Wales, to somebody in Melbourne who's in Victoria, you just charge 10%. The money gets paid to the Commonwealth government, right? Or the central government in Indian terms. That's not what's going to happen here, right? And as soon as you go down that path, then all of a sudden you have to then start to come up with a whole bunch of rules as to, well, how do we work out which state something's being supplied in? I'll just touch on those at the moment. So, and just to let you know that the way the money goes down to the states is that the Australian Treasury has a formula. It's a really complex one because we're really good at designing really complex things. That works out, there's the pool of money, and that's how much New South Wales is going to get, and that's how much Victoria is going to get, etc. Right? If you could convince your politicians to do the same thing, I can guarantee them one thing: they will get more money and they'll do it at less cost. Right? The only thing they have to do, they can shift their employees to working for a Commonwealth, a central authority, but you can get rid of a whole lot of mess. You can do PwC and KPMG out of a truckload of work because, all I can see is endless work for everybody. Taxpayers, you can see assessments being raised everywhere. If we've got potentially 30 different tax authorities administering this act, it's going to be a nightmare, right, for everybody. So the first thing is, it's a bad start. If they can unscramble that, a lot of complexity will go out of the law and a lot of things will fall into place. So just on that system, if you look at those 5 principles that the OECD have got, it's complex, it's uncertain, it's inefficient, and it's probably also not neutral, because you can see people making decisions tax decisions in order to try and minimise their costs of compliance. So that's the first thing. The second one that stands out, which is related, is that because you've got both the state and central tax, and you've got to work out where a supply takes place to work out where you actually have to account for tax, then you've got a whole bunch of place of supply rules, and married to that, a location of the supplier rule, right, to try and work out which state something happens or what type of tax you have to pay. We've actually got 3 GSTs here, right? We've got an SGST, a CGST and an IGST, when there really should only be a GST, right? So in order to work out where you've got to comply, you've got to go through and work out, where the location of the supplier is and where the supply takes place based on a whole bunch of rules that are in the law, right? Most of them come from Europe, And in Europe, you only have to comply wherever the place of supply is. We've actually gone to the other side and picked out one of those rules and put it over here and said, you've got to work out where this is, in other words, the location of the supplier, and then work out where the supply takes place, and that will determine whether you charge IGST, SGST, or state GST, right? To try and set your systems up around that is a nightmare. If you're a bank, it's almost completely impossible. And I'll give you a really simple example of why this is a disaster, right? Is that if I open up a bank account in Mumbai with a branch of a bank in Mumbai, and you think, okay, that's easy, right? Then I go and use a debit card or a credit card when I'm travelling in Delhi, and I go and use it in an ATM in Delhi, and then that transaction gets processed in Chennai, right? Now, where's the location of the supplier? Is it the branch in Mumbai? Is it the branch in Delhi that owns the ATM? Is it Chennai where it's being processed? You can see 3 tax authorities saying it's all mine, right? And you can see the bank sitting there saying, what the hell do I do? And to try and get your systems to even actually be able to account for this is really difficult, right? If you just said you've got to account for CGST, SGST in the state where the customer's address, that's easy, right? But as soon as you've got all these other variables, then I could throw 2 or 3 more on, and that's just one product, then it very quickly becomes unworkable. And so you look at some banks, that have got thousands of branches. I don't know how they're going to do it. And I've got to advise 3 of them, right? So that's, I guess in a sense, it's my problem, but there's a lot of people who are very worried about it because there's also a lot of people's jobs are on the line if this doesn't work, right? And I just can't see how that can work. That's one issue. Another issue is the matching of purchase invoices with sales invoices and before you can claim a credit. It sounds great in theory until you just think of just the massive amount of invoices that are going to be uplifted through the GSTN and then the massive amount of purchases that are going to be matched, and you can see that they won't all match, and then every taxpayer then is going to have a whole series of reconciliations that they need to do to work out what they should be accounting for and what they shouldn't and what they have to write back, etc. Compliance-wise, really difficult. I understand why they've done it, right? Because obviously what the government's done is they've shifted the non-payment risk across to the private sector, right? Whereas government will normally take on the risk of non-payment and fraud and things like that. Now they've shifted it to the private sector. Almost certainly one of the outcomes of that is going to be almost out of a lot of work with big taxpayers. I might be wrong, but I don't think so. I know a lot of businesses are talking in that context in any case. There's something about India talking about GST. The very first meeting I had in India on GST, and guys that were dragging along to this meeting, we walked in, sat down, and we said, okay, so what do we talk about first, transfer pricing or GST? And the CFO said, let's talk about GST. And I'm not kidding, the building started to shake. There was an earthquake in Delhi at the time, right? It wasn't a big one, but I thought if that wasn't a signal I should go home, I don't know what was. But anyway, I'm still here. Yeah, welcome to India. The other thing here, I'm just sort of a little bit conscious of time, that you don't see anywhere else either is this whole concept of taxing transactions between branches, right? I can't imagine this staying, but it's there at the moment. For most taxable businesses are going to get a full credit. Why are you even thinking about taxing a supply between a branch? Because you can't supply between it. You can't supply to yourself anyway, right? But the law is drafted as if you can. You're going to make a supply between one branch and another branch, and the other branch is then going to claim a full credit while the other branch has to pay tax. And none of this stuff's going through your accounts because it's not really a transaction, right? When you're a bank, and let's assume you're only getting a 50% recovery, right? Every time they deem a supply to take place between a branch, there's an amount that's going to have to be paid, and there's a 50% recovery. If it goes ahead like this, you could pretty well put the whole financial services sector out of business just on that rule, right? This is also coupled with an internet service distributor arrangement where if you've centralised procurement, then you'll spread those costs over your branch network, and that makes sense, right? But it doesn't make sense in conjunction with taxing branch-to-branch transactions. As a matter of fact, taxing branch-to-branch transactions doesn't make any sense at all, and to me it seems like it's a hangover from the previous indirect tax system, so I guess we'll see where that lands. Two other issues. Talk about compliance, right? One of my clients, who's not the biggest financial institution in the country, has estimated they have to lodge 1,700 returns a year. Like, that is insane. Sorry, but it is. And I apologise for being undiplomatic, because my uncle, my godfather, actually was a diplomat, but it didn't rub off on me at times. But it is, the only way that can happen is by automation, right? And part of this reason, obviously, is there are two reasons really. One is the matching process, so that automatically has meant there's 3 returns every month. The other thing is that there's no grouping, right? So every operating company has to have a separate registration, and it has to be registered in every branch. So when you start to do the maths and you start to multiply your operating companies by your branches by 36 returns a year, it doesn't take a lot to get into the thousands, right? So in this case it was 1,700. There are bigger, and they're only in 15 states, so I'm sure there's banks that are in all 30 that are going to have to lodge a lot more than that. And one of the returns you've got to lodge is an annual return, and on the annual return you've got to then reconcile the GST on all of your returns with your financial statements. But your financial statements are done on an accrual accounting basis. Your returns are done on invoice basis, right? They'll never match. And I don't know how you're going to manage that with the tax authority. So, yeah, you'll get close if you start making a whole series of adjustments, but then I think they'll want the accounting firms to sign off on this stuff. And, and you think, well, why? I mean, you've got all the financial information there. If the tax authorities want to audit it, they've got access to the financial statements, they can look at it. Sorry, and the other thing is too that you've got to do this on a branch by, or state by state basis, and nobody's financial accounts are done on a state by state basis. It's done at an entity level. So, so having said that, and I've got 1 minute, I just make a few other observations. Almost like what's not there in the tax, there doesn't appear to be any bad debt relief. So if you charge GST to a customer who doesn't pay you, you've just lost the tax. So go back to this concept, it's a tax on final private consumption expenditure. It's not a tax on business. That's a tax on business, right? There's no grouping rules, there's no joint venture rules, which are really important for the mining industry. I'm not sure how big the mining industry is here. There's no deferral of GST on imports. Most countries allow you to defer the payment of GST on imports because there's a cash flow implication. Generally for tax it's fully recoverable as a credit. In Australia you can actually defer the payment of GST on imports until you have to lodge your next GST return and then claim an immediate offsetting credit against that amount if you're entitled. So there is absolutely no cash flow impact there. And that comes back to this sort of compliance cost stuff, right? I've tried to keep those compliance costs down for business. There's nothing in the law about employee reimbursements. We've all got Amex cards. We all go and spend on taxis or whatever else, and Amex sends us a bill. Unless that bill is addressed to PwC in my case, or KPMG and others, then there's not going to be a credit, right? Shouldn't have to be like that. They should be able to invoice anybody. If I claim it back through work and work reimburses me for that expense, then work should get the credit. Nothing in the law on gambling. I presume that there's Indian bookmakers in India. I'm not sure how the tax applies to them. Most countries will have gambling laws, possibly apart from the GCC. The insurance rules aren't really clear. The FS rules aren't really clear either. We still don't know what's taxed and what's not. So there's still, I guess in a summary, there's a long way to go. If I have a look at what they've done with the law, it's obviously professionally put together. They know what they're doing, and often, I say the dual system's not very good. I mean, there's also political realities as well, right? This is a time for the Indian states to pull together and realise that there's a better way of doing this than to think that they can do it on their own, because if they do it on their own, We've got 30 different tax authorities auditing this stuff. It's going to be a nightmare. I guess in a way, it sort of throws a whole new complexion on Made in India, because this is a law that's made in India, that's for sure, the way it's designed. So with that, I'll leave it with you to ask questions or whatever once
Sure.
we're finished.
Sure. So we'll now request Onkar to share his thoughts. But before he does that, Onkar, before you go there, you can go there. I just want to make one observation. I was just flipping through the latest draft that got published this afternoon. A very, very important provision has been introduced, which is likely to benefit the whole consumer industry. I mean, people like you and I. The whole concept of GST is incremental tax credits should lead to price reduction. That's the whole idea. As Denis was saying, businesses should not pay taxes, it should be the consumers. Now, because of incremental tax credits that businesses are likely to get, they're likely to have a reduction in their sale price or ultimate price at which they're going to sell the goods. And if it applies across the supply chain, consumers are ultimately likely to benefit. And to make sure that those benefits are actually passed on to consumer and people do not profit out of tax credits, they've introduced a section 163, and I read that the central government may by law constitute an authority or entrust an existing authority constituted under any law to examine whether input tax credits availed by a registered taxable person or the reduction in the price on account of any reduction in the tax rate have actually resulted in a commensurate reduction in the price of the said goods or services supplied by him. The authority referred to in subsection 1 shall exercise such functions and have such powers, including those for imposition of penalty, as may be prescribed in cases where it finds that the price being charged has not been reduced as aforesaid. This is going to open up a huge opportunity for the industry to renegotiate prices or push back any price, change in law clause, so long as they are not able to see the benefit of GST coming on the price line. So I thought I'll just bring it up. Onkar, over to you.
Sorry, can I just throw something in on that?
Yeah.
We had very similar provisions in Australia, and the government set up an authority to monitor businesses' prices. There's one reason, that was inflation, right? Apart from anything else. But we shifted to a 10% GST. The last thing they wanted was a 10% spike in inflation, right? The Australian Treasury had estimated that inflation should increase by 3.7% during that period. When they reviewed it after it came in at 3.6. And the only reason it happened was through monitoring and those sorts of provisions. So, and I know the Indian authorities have been talking to the Australian authorities, and the first thing they said was price gouging, you've got to stop it.
That's right. Onkar, share your thoughts on, we'll just finish everybody's speech and then we'll do that.
Thank you, Sujit.
Onkar, yeah.
Good evening, ladies and gentlemen. So today I'm going to throw some light upon what are we expecting in the GCC countries. So GCC is basically Gulf Cooperation Council. It consists of 6 member countries, which are UAE, Saudi, Oman, Kuwait, Bahrain, and Qatar. So these 6 GCC member countries are going to implement VAT uniformly across all these countries. Now, since they have not come up with any kind of a framework agreement, though it has been talked now and often, and we expected it to be rolled out somewhere in August, but it got delayed, and then we expected it to be rolled out in October, by end of October, but it has still not come out. However, there are certain news through which we know what is likely to be implemented in these countries. So what we expect is a very important concept which the Indian GST has missed out, and which is present in the European Union and in the Australian GST, is that VAT grouping. So what we expect, the VAT grouping concept is going to be implemented in GCC. What is a VAT grouping? Now, VAT grouping, as per our experience in Australia and in European Union, is if a group company holds more than 90% of the shares of a particular entity, then it comes together as a VAT group, and the entire VAT group gets one single registration. So say for an example, in India, Tata Group. So wherever the Tata Sons would have been holding more than 90% of the shares of their own entities, then all entities will come together and get registered as one VAT group. There will be one single authority, one single company which shall transact with the Indian government officials. So no such thing has been implemented in India, but that is what we expect in Gulf. The reason for VAT grouping in Gulf is that there are a lot of family-based businesses there. So we'll almost, and there are small businesses which are established as a company. You need to establish even a shop as a company in Gulf to carry on your business. So there will be a huge number of entities, and the resources which the governments in UAE or Saudi have, there are only 10% of the population is constituted by the citizens of the state. So there are very less number of people who would work in a tax authority. So they have brought this concept of VAT grouping so that there are less number of interactions, there are less number of resources required, and a friendly environment is created even for the businesses. This is a concept which we are expecting. There are certain other concepts, since we do not have the law, so that we can only base our, we can only think of what is going to happen rather than telling you what has actually happened. So what we are expecting is the intra-GCC transfers. So there will be a transfer between supply of goods, say suppose supply of goods between from one member state to another member states. Those are going to be charged on reverse charge mechanism, something similar which we have in India for export of services. So in so we are going to so they are going to tax it on a reverse charge mechanism. And second, what we are expecting is there are going to be various other kind of rules. Based off supply rules, there will be based off point of taxation rules which will be coming. There will be valuation rules which will come in. They are coming up with laws regarding transfer pricing and many more stuff. Not income tax presently, but with other laws they are coming up. So it might not be one of the most favorable destinations to do business. Therefore, there are various concepts they are borrowing from across the world so that their the market share in the business, in the entire global business, doesn't go down. And one of the most important things which has recently happened is they were categorized into Part A and Part B countries. So Part A countries consisted of UAE, Saudi, and Oman, who were committed to implementing VAT by January 2018. Rest other countries, other 3 member countries who were categorized as Part B countries, were going to implement it by January 2019. However, now all of them have shown their commitment to implement VAT by January 2018. This is one of the latest development which has happened there. We expect that the draft rules are going to be rolled out by end of November or first week of December. If not, then latest by the end of December. That is what we expect, and once the rules are out, all the businesses need to be ready, need to have an impact analysis that how it is going to affect their business, the cost of doing their business. Now, one question which you may wonder is why should we as Indian entities or Indian companies should worry about a VAT coming out in UAE? 30% of the population in UAE or the entire Gulf is made up by Indians. Indians constitute 30% of the population there, and they are one of the foremost business houses. The foremost business houses are Indian business houses there in the entire UAE and entire Gulf region. So almost each and every entity, the biggest of the companies, be it Tata's, be it Sapujis, be it anyone, they have their presence in GCC. So since you have a huge investment lined up there, so you all need to be aware about what is going on in the Gulf, and you need to have a look. As soon as the GCC agreement is out, you need to analyze it and see what effect it is going to have on your business in the Gulf region and how you are going to manage it vis-a-vis the Indian GST coming in the next few months. So this is what is the broader framework which we expect is to be rolled out in the GCC. The rest I can update you once the GST agreement is out. Okay.
Thank you, Onkar. That was very, very precise. Ashok, over to you. Your thoughts.
I wasn't expecting another Australian to be presenting today. All the notes I had prepared, in fact, Denis has covered it. But my background is as a chartered accountant as well as a barrister practicing at New South Wales Bar. I had some occasion to, when GST was introduced in New Zealand, I was working in the tax team with two shows in New Zealand. So, sort of the issues that we were coming across in New Zealand was the transitional issues, holding of stocks, going concern issues, when businesses were sold. How does that play out in India? It remains to be seen. In terms of Australian, in terms of so the other treatment of how land is held at the date of the GST, how it is held. in Australia we have there's a treatment. I believe there's a treatment of real estate in the GST in India. Australia also has got a concept of margin, which I, as a barrister, recently haven't worked with, but there's a margin sort of a system. So there's a difference there, where an attempt is made to minimize the impact on the consumers. That it's no longer menace anymore. People know what to do, how to deal with those exemptions. So the exemptions are there. New Zealand doesn't have any exemption. But there are some exemptions like the financial transactions in the such bank charges are not subject to GST. Imports is an area that has created problems in the past. How imports would be dealt with in India. It's a very efficient system in Australia, where you can defer the tax and also the drawback system and things like that for payment of GST to the customs. So those are some of the differences I also picked. So unless
sure. We'll open it up for questions. So I think you've been anxiously waiting for your turn to ask questions. Please go ahead. I'll be conscious of one thing. We have just about 10 minutes. Okay, so ask your questions in the next 10 minutes.
The first one, the recent thing that you mentioned about the section 163. Now, putting it very simply, if someone calculates a incremental benefit of credit of around $1,000 for his business, and say for example he calculates a normal proceeds or sales proceeds of 10 units. So how does this apparently translates into price reduction? Whether that has to be a straight line formula?
Okay. So this is a very complex question of yours. It will take me a lot of time to explain, but I'll put it very simply. If today you're purchasing something for 100 rupees and there's a 10 rupees of tax, the fellow is going to come to you saying that 10 rupees of tax rate has become 18. So therefore give me 8 as additional tax because of change in law. When he says that, you need to push him back, saying that earlier it was 10% on 100. So today it cannot be 18% on 100 because your base price of 100 is no more relevant. The base price of 100 was created or constituted on the basis of certain economic considerations, namely what was your cost of purchase, what is your general operating margin, and what is the sale price. If your cost of purchases go down, and it will go down if we have incremental tax credits, then maintaining the same margin, okay, so let's say the margin is calculated on what is called return on investment. So let's say the investment, which is the cost, was let's say 50 rupees, and your ROI was let's say 10%, then your margin will be only 5 rupees, right? So 50 rupees plus 5 rupees, and therefore your sale price should be 55, okay? And therefore the 18% should get calculated on 55, it cannot be on 100. So the whole accounting world, I can tell you, and I see it as an opportunity for lawyers as well, everybody is going to gun for this clause and take the vendors and suppliers to the court or to the authority concerned to demonstrate that there has to be a price reduction or which has not been passed on. It's going to be a very interesting play and opens up a lot of opportunity for accountants. More importantly, the cost accountants who specialize in cost construction, as well as lawyers who plead before the relevant authorities. So it's going to be an interesting time.
So you see a lot of litigation around?
No, not litigation. It will be a private dispute between supplier and buyer. It's not a litigation with the government. Well, the government will arbitrate the whole issue, but it's a private dispute. Possible through negotiations, parties will not take them to the authority. But if they don't relent, I see them taking them to the court, which is good.
Sorry, Sujit, is there a chance that authority can prosecute people who don't?
The provision only talks about imposition of penalty. So there is no imprisonment, prosecution of that kind that is coming out. Of course, they say that it will come out with its own procedures, so we'll have to see what those procedures are likely to be prescribed. But the power is only to impose penalty, which could be good. It is like what the CCI does. It imposes penalty, and if the penalties are prohibitive, people will not do profiteering on taxes.
Now, this one.
Yeah, please go ahead.
The entire this concept of GST was around simplification of the business and seamless flow of taxes and proper tax administration, and one of the major factors was litigation around it. I have been talking to a lot of lawyers, but many of them are of view that probably the disputes that we are seeing now may not get drastically reduced. Reason behind, there can be a lot of litigation around classification issues after implementation of the first year.
Let me answer
Your comments on it.
Let me answer the question. Whoever told us that is going to simplify was living in slumber. And it's not possible. We have to understand that India is a very complex country. We are a democracy where we have a sovereignty available with the central government and the state government, and which is why to maintain the sovereignty of the state and the center, you have to come out with a two-tier GST. So we're doing good. We're trying to make things happen in the limitations that we have within the Constitution. We cannot abrogate the constitutional provisions and say states are no more states, it's one union. We just can't do that. Let's be pragmatic. However, litigation is India's favorite pastime. Let us realize that people do not wish to litigate. The largest litigator is the government of India. So the onus is on the government of India how much they would like to litigate. Given to us, the businesses just don't want to litigate and spend their time and money. Will the government of India litigate? Of course they will litigate. Because if there is a revenue demand, the government will not leave its share of revenue. It will do whatever it comes to make sure that they are able to collect that sum. So therefore, to say the litigation will vanish is a myth. Whether the litigation or will the litigation happen on X point or B point like classification, I can see hundreds of areas where litigation will happen, because at the end of the day, somebody in the judiciary will have to test and interpret the law. It's all about interpretation as opposed to implementation. So I think that's where it is.
Sir,
Yeah?
time is done.
Okay, any other questions? I think you are still unsatisfied. You have some more questions. Give the gentleman one more minute.
Sure.
He's waiting, he's got lots of questions.
Given the kind of change it is, how do you see the impact on non-finance and tax companies?
Non-finance.
Non-finance and tax companies.
For example, can you take an example?
Maybe the legal function or the HR function.
Of companies?
Companies.
Okay. Well, it's a very nuanced question. As long as these are services rendered within the company, so far we have never had any challenge. It's never been a taxable event. But from the look and feel of the legislation, if there are distinct persons rendering services free of charge, which means your legal function in corporate office is rendering services to a factory located in another state, thereby making them two distinct persons. By the way, distinct person is the new word that they've introduced. It's not taxable person, distinct person. If transaction is between two distinct persons, without consideration it will be taxable, which means the legal services, HR function, IT function, all of those cost centers rendering services from one office to another office in some other state will be liable to tax. The recipient will pay the tax, but of course they will get a credit. So it's more of a cash flow and compliance issue rather than any cost issue. Okay, I think we'll close it. We've had a wonderful session. Thank you all. Thank you, Ashok. Thank you, Denis.
Thank
Onkar,
you all the panelists for the deep insight, and may I request Ms. Astha Mehta from Ansal University to kindly felicitate all the panelists, please. I'm requesting you to kindly felicitate all the panelists.
Oh, you haven't told us.
Mr. Sujit Ghosh. Mr. Sujit Ghosh is a national head and partner at Advaita Legal. Mr. Denis McCarthy, Executive Director, PricewaterhouseCoopers Private Limited. May I request Ms. Anjali to please join Ms. Astha in felicitating the speakers. Mr. Onkar Sharma, Senior Associate, Advaita Legal. Ms. Mannat Waraich from Advaita Legal, Senior Associate she is. Mr. Ashok Kumar. Thank you so much. Thank you.